What's up, everybody? Bill Wilkins here. Today, we're going to talk about all this discussion around interest rates skyrocketing, 10-year treasuries up to like 1.6%, possible inflation. What does all this mean for my portfolio? And some ways to strive and invest for growth still in this environment with different levels of downside protection. Maybe you still need to grow some money in excess of 1-2% that you're getting on your bank account, CDs and stuff, but you're afraid to put the money into the market because you think it's going to go down, right? There's always this crisis going on that you hear out there that may prevent you from putting your money into companies, mutual funds that are striving to allocate capital to help solve problems, right, out there. So we're going to strive to show you some ideas around that. Stick around for that here coming up, because my mission really is striving to pursue and preserve your vision of financial freedom by really researching all kind of different ideas out there and bring those to you. You know, it could be from other advisors, CPAs, attorneys, competitors, whatever, that strive to bring those ideas to you so you can achieve your goals. So that's what we're looking to do. But let's jump into this right now. Oh, and before I share this real quick, if you are getting value, please subscribe to our channel, hit that bell icon, hit the all notification there, and then make sure you hit that like button. If you will, smash it. That helps us hopefully get this out to other people on the YouTube world. You know, share it if you can on your social media and all that. We'd greatly appreciate it. Maybe we can get up to 2.3 million likes. That would be awesome. I'd love that. We'll see. But anyway, so if you want to add us to your financial board of directors, if you will, in an indirect way, that's one way you can do it. And also, if you want to give us a call, and here we go, my cursor went away. But yeah, take a snapshot of this. If you want a complimentary consult, give us a call. Go to our website, pursuefinancialfreedom.com. In the upper right corner, you'll see a complimentary plan that you can click on, enter your data in, we'll get a hold of you and that type of stuff. But anyway, let's get into what you came here for, an update with the economic conditions and stuff. So, is the market headed for another drop, a big drop, that type of thing? Well, our guys don't think so. The current jobs report just came out today. Definitely better than expected. Unemployment rate dropping down closer to that low 6% range. There's definitely still people hurting out there, and they're trying to get this next COVID relief done here through the Senate this weekend and get this passed, but we haven't heard anything out there. But I'm going to go through right now. Ryan, oh boy, and he's going to kill me on this. It's Dietrich. Come on, I got to change this on the fly. Ryan Dietrich, our chief market strategist, and Jeff Bookbinder, our equity strategist, got a couple little points here I want to show you on their recent podcast that they do, which is fantastic. If you've never seen it, check it out. But let's take a look at this. We're talking about bond yields. So to put things in perspective, the bond yields, we're at about 0.5 on the 10-year Treasury, which has a lot of impact on mortgage rates and all that kind of stuff. We just hit about 1.6. So it went up. But in context, how does that look in relation to historical movements, and what does that usually mean for the markets? But let's jump in here. I want to hear Ryan and Jeff. So Ryan's on the left, Jeff's on the right. Let's play this so you can hear this right now.
Is what does this big surge that we're seeing in yields mean? And then kind of overlay to that, what does it mean for, the portfolios that our advisors run for their clients? So if you are watching on the YouTube channel right now, we're showing the 10-year yield. It soared last week. Really, the last couple of weeks, it's been soaring. Higher potential inflation expectations, stronger than expected economy. There's a lot of fiscal stimulus, like we'll talk about coming. Whoa. Whatever the reason, rates are going higher. Bonds have really been punished, and stocks are holding in there, but they're showing some signs of a little bit of weakness. Jeff, maybe let's start with bonds, and then we'll go to stocks next. Higher rates, as most people should know, higher yields tend to pressure bond prices as they're inversely related. I did a look at the Treasury. So Treasury, 20-year Treasury, those are longer-term bonds. They're more impacted by moves in rates. And with the jumps we've seen in yields, The TLT, for instance, the 20-year Treasury, down 9% to start the year after 2 months. Jeff, that's the worst start for long-term bonds since the first 2 months of 2009. So bonds have really struggled here. What's your take kind of from an investment's point of view on the bond side of things with yields and what yields are doing here?
Well, you told me we'll get to equities later, but the first thing I think about is, well, that's just overweight equities. Right?
There you go. That's a good point. Yeah. You're an equity strategist. You had to go there first. I don't blame you.
What do you expect, right?
Yeah.
So, I guess, first we got to think about where bonds were coming into the pandemic, right? I mean, I believe 10-year yield started last year at around 1.9. So we haven't even returned to where we started 2020 in terms of 10-year. When we were at one.
So real quick on that, and this is what this chart is showing. So prior to pandemic, we were up here. So this is like early 2019, mid 19. We had a 10-year Treasury, guys, close to 3%. Then it came down here in 19 into 20. So right before the pandemic, we were about 1.92% on the 10-year Treasury. So us getting back up to this 2% level even, our research group, they think probably is going to hit around 1.75, still not they don't think a concern at all, just natural with opening of the economy and stuff coming up with all these, the shots, the COVID-19, the vaccines and everything rolling out, things starting to open back up, looking attractive from that standpoint. And let me just back out of this. I'm going to bring them to one more thing that I want to show you on here in a bit when it comes to earnings. But there is a chart that our Mr. Ryan Dietrich put together, or he found. I want to show you this when it comes to rising interest rates. So let's take a look at this. I'm going to get myself out of the way again so you can see this. But if you follow my cursor here, the green arrow, if you look, these are rising rate start dates going all the way back to 1962 and looking at different periods all the way through the current situation where we're starting now. Started back in March of 20. Rates started climbing back up here where we're sitting on a 10-year Treasury now at about 1.56, 1.6. It's moved up about 1%, right? S&P gained or lost 39.4% during that period of time. Look at all these other periods where we've had movements, even higher rates, 1.9% movement, 1.6, 1.9, 2.1. Look at the moves the market has done here on these. So this is not what we don't believe based on my economic research group as far as higher yields being an issue for stocks. We kind of see it as bullishness. So they're kind of anticipating things opening back up and getting that. So that was one point that I wanted to bring out on here. And then back into the sticky notes, we've got earnings boom. So let me pull up Jeff Bookbinder and Ryan talking about earnings here now too. Let me get back into this. Let's get into about here. And then I'll cut to this directly. Okay, let's play this now.
He's looking at double-digit GDP growth here. That's just really hard to believe that we're here this quickly.
No, it absolutely is. I mean, so I want to ask you a question here. So we know earnings before the recession started peaked in late 2019. At this point, looking at least the estimates, it's expected that earnings in 2021 will be above that 2019 peak. Am I correct there? So new record high earnings before this year's over. Is that how we see it playing out?
Yes, absolutely. Well above.
Wow.
I think the number is now over 7% above 2019 if these estimates end up being hit. By the way, also keep in mind, early in economic expansions, estimates do tend to be too low. So for people worried about, companies tend to miss estimates, that you tend to get, overly aggressive estimates early in a year, and that's true. Mm-hmm. But early in economic expansions, right? We just came out of recession last fall, right? We think it's likely that these numbers will be hit or exceeded.
Truly amazing. I mean, it feels like we've we've been doing it. Well, we do this podcast every week, and we have been.
All right, guys. So there you go. Earnings projections. If you see this chart, 24%, and it's kind of small here, but projected to be 24% growth rate 2021 right here on the S&P 500 earnings. So still looking, based on what they're showing us, positive momentum on that. So we don't see a concern. They've actually raised their price target on the S&P 500, I think between 4,000 and 4,100. So I believe that is it. We'll have to double check that, but it is in that 4,000 range. So sitting around the 3,700 range now, I believe, somewhere in there. All right, so let me go back into my sticky notes so we can see this and pull this up in here. All right, so we talked about that, the COVID chart. The other thing with that, looking at Ryan Dietrich, what he put together on this, is that just showing you the impact of the COVID-19. Actually, it's over here. Let me pull this up. This is showing the cases, and I'll get back to the big screen so you can see it all, just without me on here. But countries leading the vaccine distribution, Israel, new cases per 10,000 people, 7-day average. U.S. cases per 10,000 people, 7-day average. It is dropping dramatically. We were up in the 100-plus range. Now we're down here in the 15, 20-plus range as these solid lines are the vaccines being administered by each of the countries. So Israel is one of the first to get them out. UK is getting them out, showing us now. And as these vaccines are rolling out, the cases are going down. Now, will that be guaranteed to continue on? We don't know that. But those are some positive developments as we see the vaccines being rolled out as well. Okay, so let me get into now. Yeah, I've showed you all this, but if you're somebody, you're not one of my clients or whatever, and you're like, oh my gosh, I still don't believe this guy. And again, I can't guarantee anything here, right? So things and I apologize, I'm back on the board here. But, I don't believe this guy. Things could go down, but, I'm only making 1 or 2%, if that. But I still want to pursue some growth with maybe high single digits, hopefully double digits, something like that. But I'm afraid to still lose money. Well, there's some strategies you can use to pursue growth with downside protection. I'm going to go over one right now real quick. We use what's called a bucket planning. And this, again, may not be for you. You got to check with your advisors, CPAs, attorneys, see if it all makes sense. And before you get into something like this, do you have all your emergency plan in place? Do you have proper insurance in place? All that stuff for different things. Disability, house, auto, all that. But here is an idea really quick that we utilize for clients in certain circumstances. I'm going to pull this up. All right, so here it is, guys. The concept is winning more by losing less, all right? So what we're saying here is that this is an example where somebody back in 2009, March of 2000, put in 100,000 right at the kind of the tech bubble back then. Things dropped 47%. Then they went up 120, then down 55 in 2007 to 2008. And then it's climbed back up 498% through December of 19. So that doesn't include the COVID thing here. But on this side, if they lost less, so maybe they lost about half. They only lost 24 versus 47 and went up 61. And then the market went down 28.2%. And then it recaptured 254%. And they still ended up in about the same location, but with a lot less volatility, right? So that's kind of the concept we use, what's called a bucket strategy. And I'll show you this really quick and blow this up so you can see it. But on here, and I'll come on the board so I can show this a little better. But what this is for people that are either getting ready to retire or they are retired, or maybe you're looking long-term growth still. So we have 4 buckets of money. The first 2 buckets of money are going to typically be money that you're going to need within the first 7 years, 10 years, something like that. if you're still trying to really, really grow money. But if it's longer term money, maybe you've got 15 something years of money in these first two buckets. But then bucket 3 and 4, this is money that anybody out there is not going to need to touch for 15, 20 years out or more, but you're still afraid to go into the market, right? So this bucket 3 area is where we strive to get people to have the opportunity to grow more than sitting in their cash and CDs, but have layers of protection built in, where you can try to strive to get those high single digits, maybe double-digit returns. So let's look at this. Let me pull this up. Here's one of the ideas that you can utilize in this strategy. So this is, and these could be in the form of what are called structured notes, and I'll get out of the way here again so you can see this whole thing. They can be in the form of structured notes that are issued by banks. You can get into things that are issued by insurance companies, such as variable annuities, structured annuities type things. And things you have to consider there are, one, be like, the expenses involved. You got to double check that, the liquidity, who it's backed by, claims paying ability, all that kind of stuff. How much can you get out if you need to, like I mentioned with liquidity and all that. So there's many things you have to think about before utilizing these. But if structured properly and if it's suitable, they can be a nice fit into a portfolio possibility. But here's what it does. So here's the quick example is that, let me get out of the way again here. So if we look at this, if you started down here in the lower left, and let's say you picked what's called a 6-year segment period, and you can do shorter periods or whatever, and they all vary with different levels. But then they have what's typically called a cap. So this example, like over 6 years, you can make up to 70% cap. There's some that are higher, some that are lower. You just have to research it. But if so you're tracking the S&P 500 typically or other indexes out there, excluding dividend reinvestment, because you're not actually in the index, you're simply tracking the price index of these. So if it goes up and the market goes up 80% on the S&P 500 price index, and you were to 70% cap, you're going to get 70%. But if it goes up 40, you're going to make the full 40 because you're still under the cap. And then if the market goes down, here's where backed by the claims paying ability of either the bank, an insurance company, whatever, if the market goes down, they typically cover different levels of protection. In this case, it's 20% on the downside. So if the market's down 25%, you're only losing 5%, if that makes sense. If the market is down 10, you've lost 0. And there's all kind of varieties of these. Some of them will actually lock in gains prior to the actual maturity date. I kind of liken it to a horse race. You're betting on a horse race to win, say $100 if he wins, but let's say 3/4 of the way around the track, he's winning. Say, hey, he might break his leg or something. Something could go crazy wrong. I want to take him off the track, collect my winnings. Well, they're not going to give you the full $100, right? Because you didn't wait it out to the end of the race. And in that case, you pull him off the track. Maybe they give you a pro rata gain of $70 or something that you won. So that's just an example, hypothetical thing, no guarantee stuff here, all that kind of stuff. But this is the way that allows you to pursue growth with layers of downside protection. There's all kind of different varieties of these. If you've never heard of these, give us a call. Be glad to actually go over them with you and see if there's a possibility that any type of these could fit after we do a full financial kind of planning analysis and stuff. So take a screenshot, give us a call, go to pursuefinancialfreedom.com, hit complimentary plan and so forth, and be glad to get a hold of you. We appreciate you joining on. With that being said, I got to cut to my disclaimer here if I can get it up. Get that running. Until the next video, greatly appreciate you joining on. Have a best rest of the day, and God bless. Thanks.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight.